So it is 10:05 a.m. calling the meeting to order. And do we want to do introductions? I mean, we have some guests on the call, so let's do them as fast as we can. My name is Keith Allen. I'm chairing the commission. I'm a state representative from Hillsborough District 42. I'm in my 5th term, and I'll pass it over to. We'll go around the room here first. Just commission members, if you don't mind.
Okay, Mike Moranti, Deputy Commissioner of the Banking Department, the Banking Commissioner's designee.
All right, and Jim?
Jim Kish, President and CEO of Passumpsic Bank, and representing banking on the commission.
All right, Jim.
Jim Kofold, State Rep.
All right.
James Karras, designee from the New Hampshire State Treasury.
All right, and we'll go to Brandon next, please.
Morning, everybody. My name is Brandon Grodd. I'm a Senior Assistant Attorney General. I am the Attorney General's designee on the committee.
Katie Taylor.
Good morning, Katie Taylor. I am a staff attorney at the New Hampshire Bureau of Securities Regulation, and I am the Secretary of State's designee.
Seth Hornberg.
I'm Seth Orenberg. I'm a law professor at the University of New Hampshire, Franklin Pierce School of Law, and I am the academic appointee.
Andy.
Hey friends, I'm Andrew Schwab. I've been in the blockchain industry for about 6 years now, and also participated on the cryptocurrency and digital assets commission.
Hey, Dan Eunice-Cohen, Head of Policy, Senior Regulatory Counsel at Crypto.com, industry representative for the commission.
I think I got everyone. If I missed anyone, please just shout out. All right, so the agenda is on nhtokencommission.org. You can pull that up. That's what I'm going to be looking at. We have our presentations posted there. I can share my screen in case you don't have it available. See. So I'm going to go to this meeting here. And we're going to just have a few minutes of commission business here. So we did welcome and introductions, approval of the agenda. Are there any changes to the agenda? This was posted a few days ago. You're hearing no changes. We'll accept the agenda. And then approval of the minutes for February 10th. That's here. And I believe, Michael, you have a change you want to make?
Yeah, on the second to the last page, that last question, it starts with me. The first part is my question, but there's a part where it references with 14 years experience. That's not me.
Okay.
So I think that Moranti is probably Amelia, or I'm not sure who that is. So that's not
This one here. This is the question.
Yeah, but the first part is me. It's just that last sentence is not me. I've not been at the banking department 14 years, and I did not make that statement.
That statement there.
Yeah, I think it was Amelia, but I don't know.
Don't remember.
Yeah,
I can go back to it.
but she's been here that long, so I could, and she was here, so I could see her saying that, but
Right. Okay.
she's not here too either. But
So we'll accept it with the condition. We'll strike that or
amend it. Yeah.
attribute it to someone else.
Yeah.
All right.
So moved.
Okay. You want a second?
Second, yeah.
All right. All in favor of that motion?
Aye.
Say aye.
Aye.
Any opposed? And this is commission members. Any opposed? All right, hearing none, so we'll do that. All right. Continuing on, we'll go right into our first presentation. And I believe Michael and Amelia, you arranged this presentation. I appreciate the feedback on that. We'll go into presentations. We have Sabrina Bergen, Yevgeny Brago. I'm butchering that name. I apologize.
That's all right. Yevgeny Shrega.
Okay. For the Conference of State Bank Supervisors. And so they're going to present on these topics here. Do you want to drive the share of your slides, or would you want?
I think that makes sense. Let me share my screen if I can make it work.
So maybe stop sharing. There we go.
See if I can make this work.
I'm watching the lobby. Just
Okay.
Let's see if this works. Okay.
All right, great.
Can everyone see my
Take it away. Yep, we can.
All right. Thank you all for taking the time. Sabrina cannot be here today. We are double booked. Our chief of staff is currently speaking at, she's our chief of staff. She's currently staffing our CEO as he speaks at the American Bankers Conference, where your commissioner of banking currently is. We had lunch with her yesterday. It was great to see her. Thank you all for your time. My name is Evgeny Shrego. I'm Senior Director of Regulatory Policy at CSBS, and I handle our digital assets issues. I want to flag first off that I've been really impressed with the work your commission has done so far. I've pitched this deck at an assumption that you all understand the Genius Act pretty well, because it seems you've been pretty deep. If there's anything I'm going through that needs a little more foundational work, please don't hesitate to stop me and let me know as I go through it. But I figured this would be the best way to use your time rather than redoing basics. So I'm going to cover three major topics here today. The first and most of the presentation will be spent on the OCC's Notice of Proposed Rulemaking that it put out about 10 days ago that implements its Genius Act framework. It's worth diving into not just for the specifics of laying out what it does, but because it's a signpost for what the FDIC and Fed might do for subsidiaries of state chartered banks. So that would include potentially New Hampshire chartered banks. And it's going to highlight some of the design choices that are available to states. Even if you don't agree with the OCC's approach, you can see where the OCC thought there was some play in the joints with the Genius Act, or a question that could be filled in with some regulatory work. And that's a place where states can make other choices. Then the next part we'll look at are what the FDIC and the NCUA have done thus far. They've both put out application rules. And while the specifics of the applications largely track the statute, both do raise some interesting things to think about as how those agencies are approaching a Genius Act rulemaking. And then the last bit, we're going to touch on state activity. I know you heard from Wyoming at some point about their Frontier Stable Token. This is going to focus more on state legislation related to the Genius Act and stablecoins over the last few months. Briefly, I did just want to jump, I know it's a big slide, and remind you around Genius Act implementation dates. We are right around this period right before the 1 year after enactment date. Congress put a lot on at that moment. In particular, there's a deadline in July for all of the states to issue implementing regulations. Or for not just the states, but the federal banking agencies and Treasury to issue implementing regulations. The state thing we think is precatory. It's not required. But so far you can see only the OCC has put out a rulemaking. So we should expect in the next few weeks the FDIC and the Fed to follow, and Treasury to put out rules. Treasury's rules will not be a regulatory framework. They'll be rules establishing a substantial similarity standard for states, and we'll spend more time talking about what that means, as well as laying out Bank Secrecy Act and anti-money laundering requirements for stablecoin issuers, and limitations and requirements for foreign issuers, which are going to be a part of this work as well. So that's what's coming up in the near future. The other important date to keep in mind for states is that 1 year after the effective date of the act, January 18, 2028, is what's supposed to be an initial certification deadline for states to submit a stablecoin regulatory framework that is substantially similar to the Genius Act. Our view is that this should not be a hard deadline. The Treasury should work with states to make it that states that need more time to come up with a well-considered framework that fits their needs have that time. There are a couple of potential legal passages they could take. If they don't take them or if they don't meet our needs, I suspect there will also be some work on legislation in the next session. With that said, let's dive into the OCC. All right, so the OCC issued this rule about 10 days ago. It's a really long rule. I think that's the first important thing to focus on. It's 367-page rulemaking. There are 200 plus questions in it. It's very carefully considered, in my view. It highlights a lot of the key design choices that the OCC dwelt on. And the OCC raises a lot of open questions. There are a lot of things that they're not, or at least saying that they're not sure about yet, and that they're really open to feedback and comment on. I'm going to give you a rundown here. I do encourage you to think about commenting if you have specifics that are New Hampshire relevant, even if the OCCs will not touch, New Hampshire chartered institutions. I still find new things when I reread the Genius Act. I'm going to continue to find new things every time I read this particular rulemaking for the comments too. So I can't tell you this is my final and best considered opinion. That won't come until the CSBS comment letter in 2 months. But I can tell you that this is my opinion so far. And I think we have a pretty good handle on where things are going. There are 6 big areas that I'm going to focus on today. I think these are the 6 areas of interest in terms of design choices for states in particular, and thinking about how stablecoins will run through into the United States. The first is the permissible activities for stablecoin issuers. The second is looking at reserve assets and redemption requirements for those stablecoin issuers. The third is looking at the way that the OCC is putting in risk management, audit, and supervision requirements. The fourth, and this is admittedly a very state-specific issue, is the way that the OCC intersects with state-qualified issuers in a couple places. The next is their rules for capital and operational backstop. And then we'll talk about foreign issuers for a bit. I think the one thing that they really don't touch on here are, again, Bank Secrecy Act and anti-money laundering. That's something that is likely waiting on Treasury before they implement, but stablecoin issuers will certainly have to do that, and the OCC will be examining for them. And they also don't look at insolvency. The OCC has a role in resolution of some of their non-bank stablecoin issuers. The states have been very interested in this. We've done a lot of work with folks on this, but it's not something the OCC has touched on. There are other areas that this rulemaking covers. I don't want to suggest that this is everything, but they tend to, one, hew a little closer to the Genius Act, such as the custody requirements. And then there's a set of assessments and the OCC's application framework. I think those are interesting as you start thinking about how to create a stablecoin framework. They're not necessarily super fascinating for policy and design choices that I'm going to focus on right now, but definitely worth a look if you're getting very deep. And the last thing I'll note is deadline comment, May 1st, 2026. So if you recall, they're supposed to have a rollout by June 18th, 2026, July 18th, 2026. So they have about 2.5 months from the comment deadline to read all those comments, and there will be a lot of comments. They will be detailed, absorb those comments, and put out a rule. It's a big lift for the OCC, and they're putting a lot into this. Moving on to permissible activities for stablecoin issuers. This is sort of what can a stablecoin issuer's business be? The OCC takes, obviously, the Genius Act permitted activities of minting and redeeming stablecoins, custodying stablecoins, managing reserves, and then it puts a little more meat on the provision that allows stablecoin issuers to undertake activities that directly support them. In particular, it says that they can levy redemption fees, they can pay fees on behalf of their customers, including in other cryptocurrency. So for instance, if you need Ethereum to get onto the Ethereum blockchain for gas, stablecoin issuers are allowed to do that. And in general, they're permitted to act as principal and agent for their stablecoins, so they can take them and distribute them as they need to do it. Then there's a general catch-all for other directly supporting activities. Our view is, given the narrowness of the directly supporting activities the OCC has laid out, that direct support should also be read narrowly. Then, that's a fairly narrow set of permissions. But then the OCC lays out a rule of 2 interesting rules of construction. One, they lay out a rule of construction that says that banks and trusts can also engage in any otherwise permissible activity that they can undertake by law. So the OCC trusts can custody, can do fiduciary activities for non-stablecoin reserves. The OCC seems to be saying that they can do that even if they are stablecoin issuers. This seems to be in a little bit of tension with the way that the Genius Act is drafted, which seems to limit activities for stablecoin issuers. The OCC reads this out of a rule of construction in Genius Act 16A. I have some questions about whether that's the best reading of that, and that's something that we'll continue to work out in the comment letter, but flagging that there's some concern there. There's also a prohibition on yield to holders for affiliates and third parties. I'll get into more depth on that. I know that's been an area of great controversy. And then there's an anti-evasion provision. So that's in the Genius Act, but the OCC, by picking it up, really makes it clear that it's going to look for activity that looks like things that are prohibited by the Genius Act, but are trying to sort of get around it with a different form. And it's going to pull those into the Genius Act as well. So there are some outstanding questions. I flagged one with respect to trusts. But the biggest one in my mind and in CSBS's mind is, what can uninsured national bank issuers do beyond issuing and digital asset service provider activities? So we know that they can be issuers. The Genius Act has a separate authorization saying if the banking regulator authorizes it, or if the regulator authorizes it, an issuer can engage in digital asset service provider activities. That's things like exchanging other cryptocurrencies, engaging in financial services related to other cryptocurrencies, and that's sort of like being the basically an exchange or a broker of those digital assets. But can they do other things? We're not sure. We're going to prod them for more clarity. The second thing is that authorization for digital asset service provider activities. That's sort of clearly in there for non-bank, for an uninsured national bank. When it comes to other non-banks, so this is one place where someone will have a choice between going to a state, a non-bank will have a choice between going to a state and getting a charter or going to the OCC and getting a charter. The OCC is very unclear about whether those non-banks can engage in a broader set of digital asset service provider activities. It says they can do it if there's some other authorization to do it, but the OCC is not granting that authorization itself. Where that other authorization comes from is pretty unclear. Right now, most companies that are authorized to engage in those activities are authorized under a state license. So do we enter a world where you have to retain a state license to engage in digital asset service provider activities before you apply to the OCC for a federal charter? That there's some tension there that I think the OCC will need to resolve. The last question is, like, what does a digital asset service provider activity actually mean? CSPS dwelt on this quite a bit in a comment we filed with Treasury last year, which is that there's a sort of broad, any financial services related to the issuance of digital assets. Some could push that to include fiat money transmission as part of the general business. We don't think that's right, but the OCC declines to provide any real color on what digital asset service provider activities are or what it will not approve. So right now, that seems to be left with whoever would authorize those activities broadly. So some interesting questions, but overall a framework that does touch on some key questions that were open in the Genius Act. Jumping to yield, that there's a real, and I will move faster on the later slides. I just think this is an important place to dwell. Moving to yield, there's a rebuttable presumption that an issuer is paying yield to holders if they have a contract or agreement with an affiliate or related third party, and that affiliate or related third party has an agreement to pay yield to holders. And importantly, the way the OCC defines yield is broadly. It's not just cash. It's cash, tokens, or other consideration. So the idea that it's just a pure interest payment will not pass muster with the OCC. For the sort of white label relationship, it doesn't cover yield paid on other stablecoins from the same issuer. So if one issuer has 10 white label relationships, one of the white label partners could pay interest on other stablecoins from other white label partners without triggering this rebuttable presumption. It also permits profit sharing, so the issuer can continue to pay profits to the white label provider, even if they're not themselves paying a yield to holders. Then the question, so one question is what's a related third party? And what the OCC says is related third party is anyone paying interest or yield on stablecoin as a service or who's in a white label relationship with the issuer. So what does this mean? Like, what does this really mean in practice? I think it probably does foreclose many of the existing relationships that we see, which are structured in ways that are essentially paying yield on behalf of the issuer. That said, the OCC clearly leaves space for some payment of yield by some third parties, and it's just going to be a question of the level of distance that is required from the issuer to not be paying yield as a service, as the OCC says. So the OCC says it's a rebuttable presumption, but it's not clear about what will be sufficient evidence to rebut that presumption. One thing you might consider is OCC, can banks pay interest on stablecoins deposited with them, even if they're not the issuer, if they're not the holder? The OCC seems to suggest probably yes. And then there's also this question of what does this mean for states in terms of their own design choices? Are states allowed to ban third parties from paying yield? I think clearly the answer is yes, based on the OCC's decision that it can. Can states allow third parties to pay yield? I think the answer to this is also probably yes, because the OCC is making a design choice here, but it's not clear that the statute says that. Now, you could argue, and some may argue that actually what the OCC is doing is giving effect to this prohibition. But I think the key is states will have a lot of flexibility in making a design choice around how to effectuate that ban on yield. Briefly on the Senate dynamics, the OCC very much, by putting this in, is wading into a very live legislative debate. The latest Senate Clarity Bill included what I'd call a nominal prohibition on yield payments by third parties. It prohibited payment in any form solely in connection with holding a stablecoin, but then it permitted rewards for transactions, for using a platform, for participation in a loyalty program, and it only imputed the yield payment to the issuer if it directed the program. There was an also Brooks-Tillis amendment, which is bipartisan, that would have limited it only to payment rewards. I think it was likely that would have passed, and as a result, several digital asset companies actually pulled their support from the bill, which led the markup to be canceled. Things are a little unclear right now. Just there have been several White House meetings convened between the digital industry and asset industry and banks, but it's unclear where things stand right now. And just this morning, there was reporting in Politico that the ABA, which is meeting today in DC, is going to push very hard against yield again. So it suggests that there's still quite a bit of space to work through on that. Moving quickly to reserve assets, as you'll recall, the Genius Act lays out a number of different reserve assets that reserves can be held in. And the OCC puts a lot of meat on the bones here. Again, I would say really worth thinking about, these are not the only right answers. These are design choices that the OCC thinks are in play. So one is, how are reserve assets valued? They say they're valued at fair value. So if there's a collapse in the value of a repo or a short-term treasury, an issuer would have to inject more capital to maintain their assets. Outstanding issuance is valued at par, which means that if a stablecoin depegs, the stablecoin issuer still has to maintain reserves as though that stablecoin has not depegged. I think that's designed to prevent runs. Issuers have to show the operational capability to monetize all of their assets. That means they have to be able to have arrangements in place to sell their treasuries or lend their treasuries out to get cash to meet redemption requests. Larger issuers may need to have a lot of partnerships. And the OCC wants to see, especially for large issuers, testing. They want to see them actually going through and monetizing assets to make sure that they can meet a spike in redemption requests. There's a series of asset diversification requirements. For those who are interested, it's about 10% in sort of immediate demand deposits or money standing to credit at the Federal Reserve Bank, 30% in liquidity that can be accessed within 5 days, limit on 40% parked in any one institution. And although the Genius Act allows treasuries to be held up to 93 days, the average weighted maturity of the whole reserve asset portfolio needs to be 20 days. That's where the OCC lands on liquidity. They also say for issuers above $25 billion, they need to hold about 0.5% of their reserves in insured deposits. That seems very small, right? But if you actually do the math there, that's $125 million plus for those issuers. So that would be about 500 banks to meet it. So circle the largest current issuer with about $75 billion in reserves. Current issuer in the US with $75 billion in reserves would need 1,500 banks to meet that. So that could be potentially operationally very cumbersome, or maybe things will innovate to meet that demand. There's a liquidation requirement. If an issuer is not meeting their reserve requirement for 15 straight business days, they've got to liquidate and shut down business. So that pushes them to move faster. And then there's redemption rules. Issuers must redeem a payment stablecoin, and that's important. They have to redeem at one. They can't set a higher floor than one stablecoin within 2 days, which can be extended to 7 days if there's a 10% redemption demand. And that's a 7-day rule. That's a gate. So if there's a run, if more than 10% of the stablecoin issuer comes in for demand in 1 day, they must hold for 7 days unless they get permission from the OCC. And then they lay out a series of fee disclosures. So that leaves, I think that shows you like the kinds of things that states can also think about, because none of this is necessarily set by the Genius Act. One question is, can issuers limit which customers they allow to redeem and how? There's language in the OCC preamble suggesting that they think they can, but that specific how they limit it and how that's squared with an issuer redeeming a payment stablecoin within 2 days is not worked out clearly. Are diversification requirements sufficient to protect the banking and financial system? I don't know that there's a clear answer to that question either. But I think that's one that the OCC is very, very interested in. And then there's a rehypothecation prohibition. One of those things that is sort of permitted is banks can treat reserve assets in the form of cash on deposit. The OCC limits that to only reserve assets in the form of cash. I think that's probably within their authority, but states can make other choices. And it's unclear if how the OCC will treat an OCC issuer holding reserves at a state custodian that's allowed to treat other reserve assets as cash on deposit and then lend it out in that way. Sorry, I've lost my ability to advance the slides. Quickly on risk management and supervision, audit and supervision, they pick up bank risk management standards. It's very process and system based. It's a fairly limited prescriptive regime. They require third-party oversight. They require IT security program requirements. They set a 12-month exam cycle and a reporting cadence in line with what they require most banks, with the potential for longer cycle for low-risk issuers. They could move to 18 or 36 months. That's so that issuers will have to provide quarterly, essentially call reports. They don't call them call reports, but they will be call reports. Many already will as bank subsidiaries or uninsured national banks. And then if there's a change in control of the issuer, that requires the same approval procedures and notice procedures as national banks. So the OCC says they're going to update their third-party risk management guidance for stablecoin issuers. That's a really important set of guidance for banks who would have these third-party relationships. So we'll see how it does it for stablecoin issuers, especially the non-bank ones. And then there's some issues around the way that the OCC treats state consumer protection laws that I'll pop over to here. The OCC in the preamble reasserts that it has exclusive supervisory authority over issuers who are national bank subs, trust charters, and federally qualified issuers. The Genius Act is very clear that payment stablecoin issuers are subject to state and federal consumer protection laws, and the state laws apply to all issuers, including state common law and the remedies available thereunder. So the OCC kind of punts on this. They say these provisions are self-executing. They don't define their scope or how they'll assess compliance. But the OCC has exclusive examination jurisdiction, so it would be good for them to say that and what they do. Especially because the OCC in the preamble also notes that National Bank Act may limit applicability of state law to trust charters or national bank subsidiaries. So they're gonna, and the OCC has been quite aggressive recently in preempting state consumer protection law and has signaled a continued interest in doing that. So it seems likely that they will try to say many state consumer protection laws that apply to other stablecoin issuers do not apply to their national bank subs and trust charters. On state qualified issuers, this is an important issue for states. Two provisions that the OCC touches on. One is the notice of transition. Any state issuer over 10 billion has to tell the OCC within 5 days that they've crossed 10 billion. And then they have 270 days to submit a capital analysis for OCC review. The OCC expects they'll have to carry at least 5 million in capital. The OCC only presumes waiver when it's required by statute, even though it has a broader set of options for waiver. Otherwise, it says they'll consider waiver on a case-by-case basis using statutory factors such as capital adequacy and the exam history of the issuer and the framework that it's subject to. We at CSBS are going to ask for more clarity and predictability on waiver decisions for states adopting a post-Genius framework. It's easier for states and for issuers to know if they're going to get waiver, if they should seek waiver, if there's more predictability. Second is the OCC has the option to intervene for a state issuer in unusual and exigent circumstances and order them to stop issuing stablecoins. The OCC does, I think, a good job laying out what those circumstances are. Imminent threat risk to issuer, to the US financial system. It's going to look at the action or inaction by the state regulator and what the risks are to stablecoin holders. And the one thing that we'd like to see there is notice to the state. Again, I expect the OCC would provide notice, but you want to make sure that that's coming in, or it's going to be a little difficult for states to, align their regulatory programs. Capital. The OCC, again, here's another place where there's, I think, a lot of opportunity for state design choice. The OCC lays out a $5 million initial requirement of common equity tier 1, additional tier 1 capital. They say it can be set higher for issuers who are national bank subsidiaries. And when they calculate it, there's no intangible asset deduction. The ongoing capital is commensurate with the nature and level of all risks faced by the issuer. There's also an operational backstop requirement separate from capital. That's 12 months of total expenses. That's based on actual expenses. And for those who don't have 12 months of actual expenses, an estimate, and then eventually aligning to reality. And it's separate from the reserve assets. So it's a separate amount of capital that has to be held. the questions that CSBS is focusing on is how that capital requirement is going to change for issuers who are currently applying an MTMA framework, as most stablecoin issuers currently active in the US are. So that 5 million capital floor would be required for about 166 million in assets under the MTMA. And so that's a very, very small issuer. That's a small money transmitter. The MTMA also requires deductions of intangible assets from the capital calculation. The OCC is open to this, and the question of whether they'll eventually land there or how they'll land there is really important. And then national trusts are allowed to adopt the issuer requirement whether or not they issue stablecoins. So essentially that says, hey, they can calculate under the old method or under this new issuer method and pick a lower capital requirement. That seems a little odd. I think we'll touch on that further. Foreign issuers, I'm going to touch on this real quickly, which is that it's a lot of the same rules as domestic issuers, same reporting supervisory cadence, same yield prohibition. That extends to all holders, not just US holders. The question that is really on my mind is they have to hold reserves in US financial institutions sufficient to meet demand of US customers. As you all know, they may not know what % of their reserves are held by US customers unless they have to do fairly aggressive know your customer and tracking of transactions. So I'm curious how the OCC intends to operationalize that. The other requirement, there's a requirement that foreign issuers consent to federal jurisdiction, both under the Genius Act and under other federal law. There's no specific statement that they need to consent to state jurisdiction, even though state consumer protection law applies. So we'll be curious to see if that is required. So that's the OCC. The rest of this should be a little lighter. We'll look at the FDIC and NCUA as well. And I think what's important to think about here is the agencies are not really in lockstep. They're thinking about different things, which shows one, that there's room for variation. The federal government's not going to accept a single line, and states should also be allowed to vary around the Genius Act. And two, there's also going to be some potentially disquiet. Really quickly, the FDIC only has right now an application for a rulemaking out for applications that's due May 17th. The application has to include business and activities description, and they're clear they want a very, very detailed description. They don't want sort of like all permissible activities, or at least they say they don't. So one thing that CSBS will encourage them to do is think about if folks want to do digital asset service provider activities, and we'll see how the FDIC authorizes those should also be described in detail. They want 3-year financial projections, including reserve management plans. They want corporate info. They want all of the policies and procedures around BSA, AML, custody, transaction processing. And they want an auditor engagement letter for everyone, even though under the Genius Act, only issuers above 25 billion are required to hold audits. The timing of the review is largely in line with the Genius Act. One thing I do want to point out is that the FDIC gives itself 30 days to determine substantial completeness. The OCC doesn't. The OCC just says, we'll determine substantial completeness. And the OCC will, but both will start their clock on 120 days. And the FDIC starts its clock from its determination of completeness. The OCC will start its clock from whenever the application was complete. So if it finds after 15 days that the application was complete on submission, they will count from the date of submission. That's another design choice that states can take. The NCUA largely follows the FDIC in terms of timelines. It's not worth dwelling on the differences. Interesting things for the NCUA is that they are going to ban federally insured credit unions from investing in issuers licensed by other regulators. So some credit unions in some states, I understand, can own assets that are not credit union service organizations. The federally insured credit unions can't own there. There's also an added consideration for applications. Both the FDIC and the OCC, they stick to the statutory criteria. The NCUA adds the ability to meet operational compliance and technology risk management requirements as an approval criterion. I think that largely fits within the sort of safety and soundness. I don't think the OCC or FDIC would tell you they're doing otherwise, but you can imagine some slight differences there. All right, and then let's quickly touch on what the states are up to. Again, I think worth noting that I am not presenting to you the substantial similarity framework that the states have, that the Treasury has released, because Treasury has not released that framework yet. We have asked them to do that quickly because states need it, especially given the timelines of state legislative calendars and that not everything can pass in the first state legislative session. And we've encouraged Treasury to basically give a very broad amount of deference to the states, not tie them to any of these federal frameworks we've discussed, just to treat the Genius Act as a federal floor and move along with broad, to allow broad variability. We'll see what they do. I'm hopeful we'll see something in the next few weeks on that. In terms of what states are doing, I think we're really seeing 4 emerging state framework options. 2 that we've seen, and I think you all have heard about, but just for completeness, the virtual currency license model, and then the special purpose depository model. And then in state legislatures right now, we're seeing 2 paths that states are taking. One is the state level Genius Act, which essentially picks up all of the different pieces of the Genius Act, and one is regulator delegation. None of these approaches have been certified yet. I expect that Treasury does not want to upset the apple cart and will create space for all 4 of these, but nothing is certain until that is released and finalized. So virtual currency license, that's sort of what you see in New York, Illinois, California, and Louisiana has something similar. That's a state license that covers digital activity in general. Stablecoin issuers fall into that. There's a capital liquidity and supervision requirements based on the risk profile. The special purpose depositories are uninsured state charter depositories that engage in non-lending digital asset activity. That's Wyoming and Nebraska. There's nothing stopping them in principle from being insured depositories, except that if they became insured depositories, they would no longer be eligible state issuers. They'd have to move to a federal framework. Most of those we see a fixed minimum capital requirement, additional risk-based capital, and bank-like supervision. The state level Genius Acts have tended to incorporate the key Genius Act provisions into state law. They'll detail out the permissible activities. They may add additional audit rules, and they often are putting in more in terms of resolution. Georgia and Florida have like fairly advanced bills. Florida's is moving quite quickly and may pass soon. And the last model we've seen, I think this is one that, from what we've heard from Treasury, they're providing some encouragement for states asking questions to move into this model, which is that the regulator delegation, it creates a licensing regime, it creates the legal category of stablecoin issuer, it creates an application regime, and then it delegates the authority to create Genius Act compliant rules to the state regulator. And it's very clear that either the regulator has to put in rules to comply with the Genius Act, or the regulator has to put in rules to get the states certified as substantially similar. But that's the sort of path that they're going on. Maryland, Alabama, Indiana's on here. I do think that the Indiana bill went down this week, unfortunately, due to some disagreements. That bill also had a prohibition on payment of yield. And so that highlights the risk that, and why we encourage Treasury to move quickly, because we know that these things can take more than one session. And I don't know that Treasury is necessarily appreciating that. Other pending state stablecoin legislation, just a wrap around of what we're seeing. The ability of the state to accept or make stablecoin payments to vendors and contractors. That's in Alabama's Genius bill, that's in Idaho. And Hawaii is looking at a bill that will allow state banks to custody digital assets. I guess that's not allowed under their law. Last bit, state stablecoin consortia. Here are 3 that we're seeing. We're seeing a lot of interest in this. I can't talk about all of it publicly, but IBAT, the Interbank Bankers Association of Texas, has been very vocal about their interest in creating a shared platform for tokenized deposits that's actually owned by banks. And they're also working on stablecoin frameworks. Custodia Vantage Bank has probably been the most ahead in terms of they've run a pilot. They're open to banks and credit unions for tokenized deposits. They claim that it's a single token that functions as stablecoin and tokenized deposit. And they're the ones who you may have seen a piloted geolocation payment where a trucker delivered something, and when they crossed the geofence, they were paid in stablecoin. Credit unions are also, I think, and QSOs are very interested in this space. One we've seen is the Metallicus blockchain and the DeLand QSO in Minnesota have partnered. They're mostly, I think, focused on creating a white label stablecoin option and digital asset custody. They say they're open to community banks and credit unions, but you can see the NCUA rule, which may make that difficult for credit unions to get engaged in. So I don't intend to endorse any of these frameworks. This is just what I'm seeing from my perspective so far. Thank you for bearing with me. I know that was a lot, and I'll open the floor to questions.
Great, that was great. I have a few myself, I'll hold off. And I think Professor Orenberg, you had one earlier in the presentation. You're on mute.
Terrific presentation. I'm in the middle of still processing information. So you were putting this out at Pentium speed, and I'm operating here at 286. So I'm processing through it. But I want to ask you a framing question that will help me get into this. Do you have a sense of why the debate on yield is as tough as it is? Sort of the temperature in the room and maybe for the other commissioners too, just explain that flashpoint seems to be blowing up the Clarity Act.
Yeah, I think this is one where banks, in particular community banks, but also the larger banks, view this as a potentially existential threat to their deposit bases. If stablecoins are allowed to pay yield and are a payment instrument as well, there's a fear that a lot of deposits will fly to, particularly already uninsured deposits, will fly to stablecoins instead. And meanwhile, I think for many stablecoin issuers, their view is this is the key for getting uptake into the ecosystem. It'll pull people in by giving them a reward. People who maybe aren't sure about stablecoins, but are sure that they like to get a nice reward rate, will move over. I don't know why it's gotten quite so locked in. I think there are probably solutions around payments that could work better, but it just seems to have really calcified, and people have taken their positions, and these things have a way of happening in Washington.
Yeah, well, it seems that first off, I agree with you in terms of what motivates it, but the conversation is on safety, right? I mean, that's sort of the framework, is that the safety. So could you articulate a little bit more? What is the argument for yield making these products unsafe? I mean, just speaking not from your own perspective, but yeah.
Yeah. So a couple of things. I think, right, whenever you see people make money on net interest margin, when you get net interest margin compression, it can create risk to the issuer. So the issuer may find its profits suddenly shrinking, but feel that if it cuts its yield, it will see essentially deposit flight and trigger a run. So it may encourage the issuer to hold unrealistically high interest rates for its profitability and then affect its solvency longer term. And then I think the other concern is just in general pushing more deposits. It's not the yield specifically, but just the push of more deposits into an uninsured system and away from the insured system will create potential risk. Again, issuers don't carry the same capital requirements as banks. They don't have the same regulatory oversight as banks, aside from the ones that are bank subsidiaries, I guess. And so there's a concern that moving this money is essentially recreating some of the shadow banking runs that we've seen in the past.
That makes sense. But wouldn't a yield limit solve most of that problem as opposed to a no yield prohibition?
It's possible. I have not thought about the specifics of that, but I do think people should think about a wide range of different answers and options as they go through this question.
And that brings me to New Hampshire. As you read the rules, does New Hampshire have flexibility on to what extent we offer yield or yield-like alternatives? Because it seems like even if there's a yield prohibition, there are ways you achieve this through a variety of machinations. And the question of how limited yield really is, I don't know if you can maybe speak to that. I mean, I know that there's like proto-yield products and there's some efficiency lost because you have to run it through a variety of systems, but you end up with yield-like product, or you call it rewards. And I don't know to what extent the state overlay is going to be able to have a lever, basically allowing more or less of this.
Yeah, so I think ultimately that's a question for Treasury, because Treasury is going to give this sort of substantially similar to the Genius Act, and one of the Genius Act things is a prohibition on yield. And the question of what is yield and how does that fit is one that Treasury, I think, is going to grapple with, because you raised the right questions. I think what you see from this rulemaking is that, especially out into the third-party world, there's a lot of space for states to play with. And so, yeah, to your point, like, can an affiliate pay yield and then engage in a profit-sharing agreement? I don't know that I think that they can, but I'm also not sure that they can't. And so I think there's space, as you say, to create structures and systems or different payment flows that don't look like yield. And then it's just a question of where Treasury lands, whether Treasury is in lockstep with the OCC or if Treasury has a different view on where the yield will come out.
Right. And I guess I'll just, for the record, I'm suggesting that the state of New Hampshire in its implementation might have some freedom to offer a slightly different product than other states, whether it is more permissive or less permissive on some of these yield-like products, including some of the rewards or the ability to have these relationships where you basically have a contract to earn back some of the yield a third party provides or provides other services. I'll stop there.
Any questions in the room?
I've got a couple of questions. Yeah, hi, Jim here. Great presentation.
Thank you.
A question for you, you alluded to the stalemate around clarity, right now. What is the dependency that the OCC, the FDIC and Treasury have on the passage of clarity? Are they, in your, from your perspective, is that independent? This goes without clarity?
Yes, I think absolutely this goes without clarity. The only place where right now we're seeing significant clarity intersection with the stablecoin rules is around this yield question. So if Congress comes out to a yield prohibition or that it looks different from what the OCC does, then the OCC will have to change its rule. But other than that, there's really no dependency. There will also be something on BSA AML, but that's not in this rule anyway.
The other question, it's not directly related, but one of the features of blockchain technologies like stablecoins is this programmability, the ability to develop smart contracts. And how is in the reading of the rules, is the OCC prepared to opine or to interpret or govern that programmability? If an institution or a stablecoins provider, develops that technology aligned with it, because it's more than, as you think about this, it's always kind of framed as a modern rail, as another rail, but it's quite different and has this feature called smart contracts that makes those things significantly different.
So this rule doesn't really touch on smart contracts, but I think that's a really important point. And I'll highlight two things. One is this notion of third-party oversight and third-party partnerships, which is that these issuers are likely not going to be doing this all themselves with the programmability. But to the extent they're working with partners to build some of these things, they need to make sure that those partners are complying with the Genius Act requirements and other appropriate risk management and consumer protection requirements. The second is just that broadly, this OCC has been, and this federal banking regime in general, has been very clear about their tech neutrality. So to the extent that a smart contract is programmable to accomplish a goal that a bank is already trying to accomplish or an issuer could try to accomplish by other means, I think the OCC would say that's fine as long as you have sort of the IT security to make sure that the smart contract is not exploitable, has sort of like whatever features you need to make sure that you are complying with relevant risk management processes. And then they're not going to actually, like there will be an education component with examiners, but they're not going to say anything specific about smart contracts because that doesn't fit their tech neutral orientation.
Okay, thank you.
All right, any other questions in the room here? And then online, if you want to just raise your hand or speak out. And then, so I'm seeing that online. I have like a bunch of questions in my head. I know I don't have time for all of them. Let me just kind of frame my question. This commission is kind of looking for the box that we can operate in. And we want to figure out, at least from my perspective, we want to figure out how we can innovate within the requirements that are set federally. So if you could sort of, bullet point where we should be looking for our state to innovate, differentiate ourselves from other states. And then sort of like a related question is, Wyoming has a whole different model. And do they have to operate within that box of requirements, or do they have additional latitude because their state is the issuer? So I'll start. I have one additional question.
So let me take the second question first. I think the Wyoming model is really interesting. I think there's going to be some very interesting legal questions around that one. So Wyoming, as you know, because Wyoming's not a person, their issuance is not covered by their stable coins are not covered by the Genius Act. So they seem to have more latitude in that sense to be able to pay yield or hold a different set of reserves. Although their reserve rules are fairly similar. I will say I have some question. I'll be interested to see where the various rulemakings land on this. If Wyoming is issuing what is a payment stablecoin, but not a permitted payment stablecoin, can it be listed by any digital asset service provider? Because there's a ban unlisting digital asset service provider, on digital asset service providers listing, offering payment stablecoins that are not permitted payment stablecoins. I think there'll need to be some work done and I'd love to hear from the digital asset service providers like Kraken, how they're thinking through that. I don't have an answer there. Coming back to your question on how New Hampshire can differentiate itself, I'm going to punt a little and say that I am not an expert on New Hampshire, and so I can't speak to the specific needs. But I think that the way that
Then within the boundaries of what the federal government said.
Yeah, so I think within the frameworks of the federal government, it's a fairly flexible set of design choices around yield, reserve assets, resolution, redemption, some of the risk management requirements. But at the end of the day, the thing is the business of stablecoin issuing is the business of stablecoin issuing. And so I think the innovation is around identifying business models that maybe are not well served by business models of stablecoin issuance that are not well served by the existing framework, and creating a New Hampshire framework that fits the Genius Act but is more friendly to those models. Or similarly, businesses around issuance. So whether that's being a digital asset service provider, being a stablecoin custodian, offering private keys, or offering some set of third-party services. If I had these answers, I would probably be in business for myself. But I think that's where you need to think about is just that gap between the needs for reserve assets, for redemption rules, for capital and liquidity, for risk management. Where is sort of that federal government one-size-fits-all framework not meeting the needs of a set of issuers, and how can New Hampshire meet that better?
I think I have two more questions, and they should both be short. First one, when you talk about safety and soundness, are there any requirements on the blockchains chosen to host the stable tokens? I know Wyoming's stable token commission did a whole matrix on what's acceptable and what's not acceptable as far as a safety and soundness concern from a technological perspective. Is any of that addressed in these in this guidance that you mentioned?
Not directly, no. They're trying to be, I think, again, blockchain agnostic, but I do think that they would expect any issuer as part of their risk management and as part of their application, certainly to describe the blockchains they're on and how those blockchains allow them to meet the risk management and safety and soundness requirements.
Was implied. And then my last question, the $10 billion arbitrary number, it's kind of bothering me that someone just picked a number out of thin air. What's the justification for that? Is it inflation adjusted? What happens if, let's say Wyoming has $11 billion. What happens if they say, we're not going to comply with the federal, we're not going to, consider that threshold?
Yeah, so it's not inflation adjusted. I think the 10 billion was just sort of someone looking at the various thresholds that exist already and picking it out. I don't know that there's a lot of logic behind it, except that at the moment there's, exactly 2 stablecoin issuers in the world with over 10 billion in assets. And that's an interesting question around what would happen if a state didn't want to comply. Remember, states don't lose their authority over an issuer that goes over 10 billion. They just have to share it with the OCC, which just seems silly. But Wyoming in particular, I know this is a distraction, but Wyoming in particular may be have a presumption of waiver because they've had a stablecoin framework in place since before enactment of the Genius Act. But for other states like New Hampshire, if New Hampshire got someone over 10 billion, I think you could potentially see a legal challenge. I don't know the specifics of it, but one might ask whether the federal government has the authority to sort of take that away.
I'm going to cut myself off with this one last one. In trying to figure out how to frame the question. You know what? I'll hold off on it. I'll save it for later. Any other questions for our guest here? All right. That was excellent. Definitely well needed by our commission, giving us that regulatory overview, and things are moving quickly. I did have one thing to share. I'll share it now. Just for the commission members or members of the public, I added a new analysis folder here, and I think Amelia sent this to me. This is the document that the presentation started with, so you can read it for yourself. And then there's also an executive summary analysis there. And maybe I'll add Georgia to this list. Here's a side by side between Florida, which I think passed the Senate and waiting for the governor's signature, so it's pretty far along. And then Wyoming, so they're side by side. I'll continue that side by side so we can sort of pick and choose. It's like the Chinese menu of options potentially. So just pointing that out.
Very cool. Thank you very much.
Thank you very much. It was great. All right, with that, we'll just do a time check. We're about an hour in, which is pretty good. And we'll turn it over to Bitco. And if you guys want to introduce yourself, yourselves and your team, and feel free to take it away.
Awesome. Thanks, everybody. And super grateful to be able to present some content with you guys. Let me go ahead and share my screen. All right, is my screen visible?
Yep, you can see it.
Okay, great. Okay, so maybe I'll start with my introduction. So happy to be here today. I'm Eugene, and I'm currently VP of Product at BitGo. I oversee our stablecoins and fiat vertical. So everything that we're talking about today is near and dear to what we do at BitGo. For those who are not familiar with BitGo, we started as a wallets company, moved into qualified custody with our state charter as a trust company in South Dakota. Recently became a federally chartered bank through the OCC trust as an OCC chartered trust bank. We provide digital asset infrastructure is what we call it. And we serve companies around the world. We have 7 different regulated entities around the world that provide custody, trading, lending, and a whole number of those, both as like an interface for institutions to use, as well as an API, which is underpinning many different financial technology companies around the world. And prior to doing this at BitGo, I was the founding head of product of a company called Brassica, where we actually had a state chartered trust company in Wyoming. So a lot of stuff about Wyoming is probably familiar to me. And there we were basically a real world asset tokenization platform. We were acquired by BitGo in 2024. And since then, I've been working on our stablecoin as a service product. And today I'll talk to you briefly about sort of the different types of stablecoins in market, some of the perspectives that BitGo has, and maybe just some considerations for this commission to think about. Most of what we're going to talk about today, I don't think BitGo is like endorsing or any particular direction or recommendation to the commission, but really just sharing sort of knowledge and open to questions to try to help you guys make your next set of decisions. Okay, so at a glance, just a couple more slides about BitGo, and then we'll jump into the content. We're, I think, one of the longest running digital asset providers in the United States. We've been operating since 2013. As I mentioned, we're an OCC chartered digital asset trust bank. Our primary business is custody. We custody over $100 billion worth of digital assets on platform. We have the broadest support of any coin or token support in custody. We work with many of the most promising and new blockchains we have for the last 5 or 6 years, and often their first stop is actually to come to BitGo to get custody for their assets. We service, like I mentioned, some clients directly, and others we service them through either our wallets or our crypto as a service function for other companies who are using our APIs to integrate and provide this type of some type of digital asset infrastructure to their clients. And I already mentioned that we have like 7 regulated entities around the globe. We operate in Europe, in Asia, in the Middle East, as well as here in the United States. And then just recently, this January, we were publicly listed at the New York Stock Exchange as a public company. So if you think about BitGo, like I mentioned, we started at the bottom of this diagram here with wallets, and our founder and CEO, Mike Belshe, was actually one of the inventors of multi-sig Bitcoin wallets. And so we just kind of started building really secure wallets back in 2013, moved into qualified custody as we began to work with institutions, and that was a service that they needed. And so that's when the trust company in South Dakota was chartered, and BitGo's qualified custody services began. Within that, as different institutions and folks began to open qualified custody accounts with BitGo, we launched the Go Network, which is settlement between BitGo accounts. And so this sort of is a function that attracts and liquidity providers, market makers, exchanges, et cetera, who need 24/7 ways to settle. On top of our custody services, we have our prime solutions, which include trading, staking, borrowing, lending, as well as like collateral management. So in the case of a number of bank partners, they'll use us for like a tri-party arrangement for settlement, so that the banks themselves don't have to custody digital assets in order to coordinate those types of transactions. And then within trading as well, we have like sort of an e-trade experience, as well as a OTC prime trading function for our customers. And then on top of all that, we have these infrastructure as a service solutions, which I think are probably of most interest to this commission, where we have a stablecoins as a service, crypto as a service, and token management. So very quickly, what those are is that's sort of utilizing all the infrastructure underneath, which are wallets, custody, our smart contract expertise, as well as our regulatory and licensing posture as a trust bank to be able to issue stablecoins in partnership with program partners, as we call them. And so most notably, right now we have two large institutions that we work with. One would be World Liberty Financial. The USD1 stablecoin is issued by BitGo in partnership with World Liberty Financial. And then separately, we also are able to provide stablecoin as a service where we are not the issuer. So SoFi would be a great example. We are the infrastructure provider for SoFi Bank's SoFi USD stablecoin, which was, I think, just publicly announced a few days ago. I think it's it was just announced a couple days ago. Crypto as a service is similar, where we take all of our infrastructure below and we make that available to financial technology companies, where they can call our APIs and essentially open custody accounts with BitGo, in which they are able to operate their business on behalf of their clients. So those customers that they're onboarding have a direct relationship with BitGo, but the API allows for those clients to perform some functions and/or authorize actions on behalf of those users. Okay, so with that backdrop, one more slide of backdrop. I kind of mentioned this already, of just like sort of who we are and why we participate in the stablecoin space. WBTC as well. Most wouldn't consider it like a fiat reference token, but it's basically in the sense a crypto asset-backed stablecoin, where you have a wrapped asset that the underlying treasury is Bitcoin, and then there's a wrapped version of it on Ethereum that's created. And WBTC has been around since 2018 with zero incidents, and is issued by BitGo as well. So just another example of sort of our experience in this space. Okay, so the first kind of slide is like, why stablecoins? Like, why are folks interested in it? I think a lot of folks here probably have a good grasp of this already, but just wanted to set the stage for folks who are watching. Stablecoins themselves are interesting only when they have network effects. So that's sort of the first highlight, I think. In almost any case, if you create a new payment instrument, other folks have to be willing to accept it. Other folks have to be willing to remit it, and then you sort of need a market that justifies and supports and pegs the price at the $1 peg that you're looking to get with a stablecoin. But assuming all that is true, you do get some of these benefits like 24/7 settlement. And this gets even more exemplified when you think about the future of tokenized assets, where either private and public assets may be on chain and now available to settle 24/7. It would make sense that you would want a representation of the US dollar on chain as well, so that it can also settle 24/7 as opposed to just being restricted to banking hours. In some cases, there can be lower costs. So when you think about card networks and things like this, if folks were remitting stablecoins directly to businesses or to governments or between peer-to-peer to each other, you can imagine that fees could be lower, since the fee itself would just be the cost of the transmission as opposed to the number of intermediaries that may be in between. There's definitely cross-border efficiencies when you compare it against things like SWIFT. and correspondent banking. Transmission of a stablecoin doesn't necessarily, it doesn't change the cost to basically move across border. It's basically the same thing from wallet to wallet. So there's definitely efficiencies there. And then programmable payments comes up more and more these days, just relative to the conversation about AI and AI agents and what they're doing. But there's this, there's sort of two factions of programmable payments. One is like orders of efficiency. So just one example would be, let's just say a bank is already conducting escrow for tons of different use cases. Maybe those could be offerings for private offerings, or these could be for funds, things like this. A stablecoin could be programmatically, a stablecoin, you know, with a smart contract could be employed to hold funds for various reasons, as well as release funds at the close of escrow for various reasons automatically, just as an example, which could create some efficiencies there. So that's like one way programmable payments is relevant here. The other way that programmable payments comes up a lot is in the context of agents or proxies of folks, AI agents spending on behalf of their sort of masters, if you will. So let's just say like I created an AI agent for myself and I wanted to go buy things for my business. In some ways, there is a need for a more deterministic payment method than potentially the current liability framework of like a card network for what that agent does on my behalf. And so in some cases, programmable payments and stablecoins come into play in that part of the conversation. The other thing is auditability, transparency. In almost every case right now for payment stablecoins, they're on, you know, public permissionless chains. So you know, in theory, every transaction is recorded and immutable in a public ledger. Although custody providers like BitGo and others, we do have obviously off-chain ledgers as well. So there are some types of activities that can occur between, you know, almost like book transfer type activity that isn't necessarily on-chain. So with that, I think it's important to then jump into and just kind of define stablecoins. And what's a little bit difficult is, you know, the US has created this framework, the Genius framework, which very clearly defines what a stablecoin is in that context. But there are many, many things. If a consumer was to go search on Google for stablecoins, there's a ton of assets that don't meet those requirements, and also some assets that are just completely different in general that are classified as stablecoins. And so on the top left here, you have one-to-one fiat backed, which I think we're very familiar with at this point. But each token is backed by one unit of the equivalent fiat currency, whether that be USD or Mexican pesos or whatever currency is being considered. It's the most regulated in the sense that like most regulators around the world who have policy around this have centered around this type of stablecoin. And you know, these are redeemable with the issuer. And the second type on the top right is asset backed. And there are many assets today that are essentially backed by crypto or real world assets like US treasuries, gold, et cetera. And often these are yield bearing, so they can kind of blur the lines into securities, and some are considered securities like tokenized money market funds, things like this. But some of these that are, you know, are kind of blur the lines because they can be called a stable coin because some of them may peg their value to $1. And some of them are incrementing where it's the value of the price of like a share in a fund, for example, and it increments in value over time. But they still may market themselves as a stable coin because they're based on the stability of the US dollar. And so that can obviously create some confusion in market when you think about, you know, what is a stable coin. The third on the bottom left here is algorithmic. And so what this really means is just that the peg or its value is not based on, so if there was 100 tokens in existence, there are not $100 backing the reserve per se. It's maintained by code and incentive mechanisms to mint and burn tokens. So, you know, this is basically just a layer of abstraction that an algorithmic stablecoin would have that says, you know, the way that we maintain the value is based on market demand. If it depegs and it begins to devalue, then we'll burn tokens such that we will come back to being worth $1. Likewise, if it's inflating because there's more demand, then the protocol itself or the code will mint more tokens to then increase supply and then, you know, decrease the value back to $1. So it utilizes code and these incentive mechanisms to do so, rather than holding fully backed reserve collateral. And there are examples of these that are in market today and just not available, in most cases, not available to US customers. One thing that's important though is when you think about what's available and not available, there's always going to be this concept of like self-custody, where folks just have self-custody wallets that they hold the keys to. They could participate in these decentralized exchanges where they can basically get access to these assets that centralized exchanges in the United States after the Genius Act may not be able to provide access to. And I think what will be interesting for consumers and for states in general is their constituents, it might be difficult to understand the difference between when you're interacting with a centralized exchange and when you're interacting elsewhere, like with a protocol. And so I do think like, again, the understanding these is important so that, whatever take the states make on it, they can ensure that this is clear to their constituents. And then the bottom right is kind of can be a mixture of any of these, where, for example, there could be stable coins like Tether, which claim to have one-to-one reserve backings, but in a mix of assets, where, for example, they hold some gold or they hold some different assets that back the asset. USDE is this way, where it's sort of a mix of crypto backing as well as fiat backing. And some of these also have an algorithmic element to them as well, in combination with reserve backing. And really, the main thing to know about this is that it just varies. There's wide variance in terms of the implementation of these, but to a consumer, they may see marketing that all of these are called a stablecoin. Okay. So when we think about pegs in general, a common question actually at BitGo, given that we issue some stablecoins that we get, is questions about how is BitGo guaranteeing the peg, or how do issuers guarantee the peg? So I thought I'd maybe put a slide up of like today between primary and secondary markets, how the peg is actually maintained. And that way, we can have an understanding then of how these different types of stablecoin models how they deal with stress in a bank run or stablecoin run type of situation. So on the left side here, if you think about the primary market, what the issuer is promising is the issuer has an agreement with each eligible institution who can mint, and says, hey, we guarantee you some type of redemption rights. And so under Genius, as it was just shared in that great presentation prior, there's these rules about, hey, you have to do this within 2 days or within 7 days if there's a stress event with greater than 10% redemption. And that right between eligible minters and the issuer is essentially this primary market backstop. And so that's what guarantees the peg between those institutions, and they're typically large institutions. Many of them are market makers who are actually in the business of performing an arbitrage loop on these in the secondary market. They're able to do so with this backstop against the issuer. This type of access is not typically accessible to consumers. So for example, like consumers today can't go to Circle and mint directly. They have to go get USDC on the secondary market on Coinbase or one of these other types of exchanges. So just as an example, let's say Eugene Inc. was onboarded to BitGo as eligible to mint USD1. If I was to send 1 million USD1 to BitGo, they have an obligation to me to then settle $1 million back to me in exchange for those tokens, and then they'll burn those tokens. And so that's how the primary market between me and them is supported. On the secondary market, what's essentially happening is exchanges and decentralized exchanges maintain liquidity either in pools or in their liquidity wallets or through market making activity. And so there are these entities, liquidity providers that basically act as arbitragers here, where anytime the price deviates, they're either buying or selling the asset. In many cases, they're also guaranteeing either with the issuer or with the exchange that they'll provide some depth of liquidity at a certain price in that market. So if you go to Coinbase, for example, and look up USDC, you'll never see that it's exactly $1. It's always like, 10, 5, 7 basis points off from $1. And that price is not something that the issuer is directly guaranteeing. The issuer is guaranteeing the underlying liquidity providers and exchanges who are then making markets in that secondary market that you're looking at. And so what's important to know about that is under stress. So think like a negative news event, a bank failure that might be exposed, that the reserve might be exposed to, these types of things, or even a bridge failure, where let's just say there's a bridge between Ethereum and Solana, and let's say there's a bridge failure, which then causes there to be a price gap between those two assets on those two chains. These types of stress events will affect the secondary market pricing outside of the direct issuer's control, right? The issuer can't reach in and say, hey, no, Coinbase, stop what you're doing, I'll pay for it. or I'll redeem, those folks who are holding it on the secondary market don't have a redemption right directly with the issuer. And so that's sort of the example that I wrote here, where like a market maker, for example, buys USD1 at 3 bips off and up to a depth of 1 million. The consumer is basically selling it then, and then that market maker, because they're buying it at that rate, at that depth, the consumer basically is able to settle and get 0.997 against each of their tokens, for example. And so that's just the typical relationship of how PEG is maintained. And the arrows in between here are that arbitrage loop I mentioned, just between those market makers and those secondary markets that are occurring. So if you think about from a fiat-backed perspective, which is what Genius specifically endorses, I thought it'd be helpful to maybe talk about like how a stress situation or a stress event gets absorbed in this primary secondary model. And the key here is that like the reason why one-to-one fiat-backed ends up faring more predictably in these cases is that there's a small number of known variables, and the primary one has a known backstop, which is that primary market with the issuer. And so the less variables is sort of helps ensure that there's less risk to the holders. So let's say there's a stress event on like USD1, just as an example, like a bank failure or negative news about a particular institution that holds reserve capital. There's going to inevitably be sell pressure. And so holders, whether those be retail, institutional, whoever's holding and using the asset around the world, they may rush to their nearest venue, an exchange, to basically sell that stablecoin. And during that, we may see a temporary market depeg where the price dips, just for example, from 99 cents, this will be quite severe, but like let's say to 95 cents. And this gap appears in terms of the price of the asset against $1. And so what would happen at this point is the first backstop is basically the arbitrage loop, where all the market makers that sit between the primary and secondary market, there would be an opportunity for them to make money, right? Where they can basically start buying stable coins for 95 cents and redeeming them for $1. And so they can profit from that spread. So the first sort of automatic market correction mechanism would be that innately those traders and those institutions would want to make money. And so they would begin trading as a backstop to try to bring that back closer to $1. If they run, but there's a limit to this where they then need to, the only way they can continue to do this is if they have the capital efficiency to then burn those tokens and get back to $1, in which case they may run back to the market and buy more stable coins at 95 cents, 96 cents, 97 cents, etc. And so what's super important then is that they then are able to go right back to the issuer, that issuer backstop of the primary market, to burn those tokens and settle back to cash or whatever asset that they're hoping to receive on the outset. So that's just like in a stress situation. The most important thing basically is the issuer has to have enough liquidity to cover those types of events, and it is able to fulfill those obligations in a timely fashion with the eligible minters that they have contracts with. And then secondly, that there are market makers in place and or liquidity pools in place that will sufficiently perform this arbitrage loop for the venues that the asset is available on. So you can kind of see, I guess, the point of, I guess, trying to make here is that there's a direct correlation with the issuer's ability to redeem, but it is a little bit murky in terms of like how it gets enforced, in the sense that it's not direct to the consumer of how that price is represented. So when you think about algorithmic stablecoins, which often are the subject because there's been failures in the past, like Terra USD, the reason why there's more scrutiny here, and under Genius, there's a sort of a note that there needs to be a treasury study on this before there's ruling around algorithmic stablecoins. On the one side, the pros is that an algorithmic stablecoin, like most financial products, often like most dynamic financial products, there is an opportunity potentially to deliver greater reward or in terms of our yield for the issuer. But there are more variables and therefore more risk, and not all of those variables have backstops that are independent. And so what ends up happening is you can have a number of independent failure points, which can kind of like cascade if there is a stress event that basically causes one of these mechanisms to fail. So just to compare a couple of these things, like the PEG mechanism in a fiat back, like we talked about, there's always the primary market. You can come give me the token, I have the dollar or the liquidity to sell assets to get you the dollar in a low risk permissible asset to give back to you. In an algorithmic situation, the algorithm, by minting and burning, as we talked about, sort of on those incentives, the algorithm is sort of guaranteeing the peg by burning and minting on its own. So it's not necessarily true that there's always an asset to redeem for each token at any given moment. In a stress response, there are still similar arbitrage mechanisms for an algorithmic stablecoin, in the sense that market makers will still be making markets on these other secondary venues. But it doesn't guarantee that the algorithm itself can recover. So you kind of have this like other variable where in a negative news event or a stress event, it's the arbitrageurs have to trust a protocol or trust this algorithm to continue to be able to mint or burn accordingly, so that the peg is maintained. If there's a stress event that may not be present, right? There might be trust shaken at that level as well. In which case, if arbitrageurs then decide to stop arbitraging, then now you sort of have a cascading set of events, which is maybe loss of some stress event that creates a loss of a trust in the asset. But now the actual arbitrageurs, who are your secondary backstop, may be wary about the depth of liquidity they're providing in an asset that might be in trouble. And then if you think about liquidity risk, if liquidity providers then exit under that stress, the spread just continues to widen. And again, then the next set of arbitrageurs, there's more stress, there's more potential for them to stop providing that secondary backstop. So it kind of creates this cascading mechanism because there's a second variable here, which is faith in the algorithm to be able to maintain the peg, as opposed to faith in the issuer to just have 100% of their assets reserved. The last thing is, like, from a governance and risk perspective, in a fiat-backed situation, there's an entity, like for example, in BitGo's case, BitGo, that's responsible for the reserves and for the parameters in which the controls that we control these assets, and we're responsible for that. And we also have to disclose public audits of what we hold in reserves. On the algorithmic side, this varies widely, so it's not to say that all of them are this way, but many of them require either on-chain governance votes. There are also different varying levels of like public audits that are available for each of these types of assets. And so some of those things can either slow things down in the case of a stress event when there needs to be decisive action to ensure that redemption can continue. And also there can be just general issues if there's not as much transparency and oversight into how those reserves are backed, although algorithmic. Again, it kind of creates this cascading set of breaking of trust that can then just widen and widen the spread. So I guess the main point here is the design quality varies widely. If you look at each algorithmic asset that's out there today, and the ones that have existed in the past, there are examples that have been operating for years without any issue, like DAI, for example. But this is sort of just like a general framework of like why one ultimately has more risk than the other. I think what's important to highlight and think about is like what consumers can't easily see today. And I kind of alluded to this earlier, where like all of these things are called stable coins in the market today. Most consumers, I would say, first of all, they don't really know. There's not an easy way to, nor is there probably widespread education on what to look for and how to know what the risk is associated with a stablecoin. So just some general questions of like, who is the issuer, what's in the reserve, or how do they hold the reserve? Do I directly have redemption rights? Is this insured? Is this a Genius Act asset or is it not? And does the name of the asset indicate anything about its safety or how it's backed? Like, these are all like open questions I think are super important to think about. And you think about like an issuer from the first question. In today's world, these could be US entities, these could be offshore companies, these could be in a US territory like USVI. These could be software protocols, right, that don't have a company or a person associated as the issuer. And so it can be difficult for consumers to discern. From the reserve perspective, as we talked about today, all of these types of assets, many of them are called stablecoins. Many of them also have the same types of names where the name has USD in it, where it'll say like USDE, USD this, USD that, and yet they have completely different functional ways that they operate and different risk profiles. And so I just think that's worth considering when you guys think about your constituents and also not to say that you have to restrict all these things. It's not necessarily our recommendation, but just something to consider, especially as you guys think to implement Genius and other things. The other thing too that I think is commonly misunderstood here is this: do I have redemption rights? I think for most folks, like the general thought, like even if you go read the description of stablecoins on like Coinbase's FAQ, they describe a stablecoin as an asset that has a redemption right, where you can exchange it for $1. But to a consumer, they may believe that, oh, like when I go to a secondary venue, I am in fact exchanging this value with an issuer. When in fact, like as we've discussed, they're selling the asset, they're buying and selling the asset in these secondary markets at the price that's available based on liquidity available for that asset. So these types of things, I think, are there's probably just gaps in general of like consumers understanding what they're doing when they opt in. So just some general considerations that I have, and then we kind of open up for questions. And again, BitGo, these aren't necessarily recommendations from BitGo, but just general things to think about. One is, and I think this was also really helpful after the first presentation, but I think just aligning with Genius Act framework is helpful. I think the Genius Act does a good job of, or at BitGo, we are doing everything we can to be as clear and as transparent as possible. And I think the Genius Act helps with this. Two is like, I think clear asset classification at the point of sale is probably something that is not, that might be something worth considering. In the sense that, mandate that these things are labeled in some way as a Genius backed asset. That way consumers can be more aware of what they're transacting with, as opposed to just having to trust what they see, what they search online or through whatever AI interface that they choose to ask questions to. The third is like consumer disclosure standards of, today there are Genius compliant stablecoins, and many stablecoins will issue these third-party monthly attestations. Some are quarterly attestations, but maybe just a disclosure so that consumers have some way of evaluating and knowing that how these things are held, whether they have insurance or not, which obviously we know they do not have insurance, and that there are always these secondary market risks that we've talked about today. And I don't think the goal here would be to make people not want to do this. The goal would just be to ensure that it's disclosed. I also think there's a lot of talk right now, specifically just on payments and the cost efficiency and 24/7 nature of stablecoins. There's a lot of tokenized RWAs and stablecoins kind of go hand in hand. If you think about bringing an asset on chain where it now has more easily global reach for investors to buy and sell that asset or invest in an asset, there's also this need, like I mentioned earlier, where stablecoins will kind of like grow alongside that, which is it will be not everybody in the world who may want to invest in this will have a US bank account. And so, the need for dollars to be on chain to move at the same speed as these tokenized assets will be something that sort of helps catalyze that growth. So just something to watch for the commission is to think, if you guys see use cases around tokenized RWAs, there's likely like a stablecoin component to that as well to consider. And then lastly is just, partnering with qualified custodians. There's a number of qualified custodians besides BitGo, but institutional custody infrastructure helps from like a regulatory framework to be an enforcement backstop. If requiring assets to be held with regulated custodians can help provide more meaningful consumer protection without necessarily having to ban innovation. So just as an example, it's like instead of holding reserves in some unregulated let's just say a self-custody structure, it being held with a qualified custodian ensures that there's more regulatory oversight about how those assets are held. One other thing too that I thought about to the question earlier of how can New Hampshire innovate on stablecoins, I also think a lot of the stablecoin activity that you see today is from financial technology companies and crypto native companies. But I think, the more that states like yourself can be supportive of like non-crypto like native, non-crypto native banks that want to either take, receive and remit stablecoins as deposits, or want to issue their own stablecoins. I think that's a way that states can also be really supportive of innovation. Ultimately, like the dream state for a stablecoin is that a consumer has supply of stablecoins, right? And the more that bank infrastructure or banks issue their own stablecoins, then the more supply that's basically introduced, and the more that the network effects of the this type of asset, this class of asset grows. So it's not always just going to come from like the Circles or the BitGos of the world. I just encourage this commission to think about how they can support even at like a forum level or community level banks within your jurisdiction, considering how to issue stablecoins themselves. And I think that's my last slide, and we can move over to Q&A.
Thank you for, that was obviously a custom presentation tailored to New Hampshire, so we really appreciate the work that went into that. I'll open it up to the floor. I can see the room a little easier. Any questions in the room?
We got one online.
Okay. Any questions?
I've got one.
Okay.
A great presentation, Jim here speaking. Talk us through a little bit on tokenized deposits, where that kind of fits in the ecosystem that you discussed.
Sure. Yeah, no, right now tokenized deposits get a little bit conflated. Like in a lot of conversations, if you think about a tokenized deposit, it's a bank taking some selection of their deposits, not necessarily all of them, and they're creating tokens that represent them on chain. And they may do that for various reasons, settlement with other bank partners. They may do this just for internal efficiencies. They may do this for programmatic stuff like the escrow example I had given earlier. But the key thing there is that not these tokenized deposits, many banks are sort of, don't want these things to be publicly and permissionless on chain, where folks can see what's happening with these tokenized deposits. So that's why you see a lot of larger banks like JP Morgan exploring like a private chain where they would issue these tokenized deposits. The second thing is that just custody of a bank deposit isn't something that's just freely transferable, right? Like, for example, BitGo as a custodian, we wouldn't want to hold, Bank of Jim's tokenized deposit without having a direct agreement to be with the Bank of Jim to be able to hold that deposit for whatever purpose that Bank of Jim wants to use it for, or one of their correspondents. So it's even though there's a lot of conflation online of like, oh, could a tokenized deposit be used as a payment stablecoin? There are just generally some framework things there that probably won't conflate the two. So that'd be probably my first comment, which is a tokenized deposit is explicitly a bank use case and likely will be a bank to bank or internally within the bank type of use case. Whereas a payment stablecoin is in most cases purposely permissionless and used for transactions amongst holders, and is freely transferable to any kind of wallet, typically outside of screening for OFAC and SDN.
Thank you. Yeah, that ultimately it has to get back to USD, so the kind of at the end of the day, consumer gets the US equivalent in cash in their bank. So I think kind of end game, you're almost at the same. You're at the same place.
One thing that. Just to wrap that, I think one thing that we will likely see where these two conflate a little bit is, let's say Bank of Jim tokenizes their deposits, and so now they have some representation on chain of a set of their deposits. It's feasible that there's a world where Bank of Jim then issues a stablecoin where the backing reserves are their tokenized deposits, and then it does a couple of things. One is, technically there's like more real-time transparency now, because you could easily see on chain, there's the bank has 100 tokens over here and 100 tokens over here, and that's a little bit easier to manage than maybe trying to stream bank balances or asset holdings real time, just as an example. So that may be some way in the future where those two things intersect. So I just wanted to make that.
So just to jump in, tokenized deposits can be fractionally lent out, right? Like, a stable token isn't necessarily right.
Yeah, I think there's that differentiation. I think it's really important. Is that the Bank of Jim, thank you, haven't chartered it yet, but that has conceivably, if it's a demand deposit and backed by demand deposit, the institution can lend 90% of it, holding 10% in reserve. requirements. So that's just a really critical function of banking, is that ability to lend on low cost deposits. So I think that's an important distinction as we're considering that network. Is that, that's a tangible benefit as you'd see it across, from an ecosystem or from the economy, or not.
Sorry, I didn't catch the question on that, Jim.
Oh, no, I was, just thinking about the ability to lend on, for bank issues, tokenized deposit. That has a secondary or benefit of being able to lend on that direct on that deposit. But on what that, one for one that's backed by that tokenized deposit.
Yeah, I think what's kind of interesting about it is it's like, just to give another example today. So for USD1, BitGo has bank accounts, like demand deposit cash accounts with banks where we hold some of the reserve capital. Those banks, they don't classify those accounts in a different way per se, right? Those are just demand deposit accounts, the commercial banking accounts that they have for the benefit of holders of that asset. So theoretically, so long as it meets their capital requirements, they're allowed to do what they want with those deposits. Those are deposits for them as normal. So if you think about it, in that situation, there are not necessarily one-to-one assets at that bank account, right? Other than what meets their capital requirements. So then if you think about if that bank itself was to then issue a stablecoin, there, like, you can kind of see like the slippery slope here about like when and where are these assets actually present and when are they not. So I do think there's going to be a need for like most banks are likely either going to have to prove to it's going to be like a proof to market kind of thing or a regulatory thing, where they'll either have to classify a different set of rules that they apply to a different set of holdings or elsewhere. Otherwise, it will almost mean that a bank issued stablecoin will be less backed than a non-bank issued stablecoin, right? If you think about like the implications of that. So there are some like complexities to think about there of exactly what you're talking about.
Yeah, no, it's a great point. Can I watch?
Yeah, then Professor Orenberg's.
Sure.
Sure. Go ahead.
Okay. Your description on the arbitrage between the primary and secondary was about the best that I've ever seen. That was really great. So I've never had anybody go into the depth there. I know in addition to, gas, do the networks try to hold a little for themselves on the basis of the arbitrage? Is that a way that works make money?
So just to ensure we understand the different parties here, exchanges and market makers very rarely, I can't think of a market maker that has their own, like a widely used blockchain of their own and token. So they are not typically playing in that space to make a cut. They're making money on trading, and in this situation, arbitrage. In the exchange side, many exchanges do have their own chain. And the way that most blockchains operate, not all, but most, is it's less actually about the fee itself. So the fee is there to create tokenomics and incentive to pay rewards such that like the chain can continue to perpetuate in like a decentralized fashion so that everybody will continue to participate. The main thing that they're trying to do is drive activity. And the way that they drive activity on that chain is, one, having assets on that chain that are transacting, and two, the need for their native token. So most blockchains, like Ethereum has ETH, right? And all these different, and what they're trying to do is, in order for you to be able to pay gas, you have to have that asset. And so that's actually what they're after. It's like less about the fee. The fee sort of just feeds into the economics of the chain itself. It's more about holdership of. It's the most like kind of simple thing I could think of is like Starbucks. They don't like, they know you're going to get coffee, but they want to hold your $25 increments in their app, because then you're just going to perpetually go back and they're now holding a much wider base of future transactions and activity from you. It's exactly the same way with these blockchains. So that's the typical economic model. So I'd say I just want to make sure it's very separated in a way from these market makers who are doing the arbitrage typically, at least today. One other comment is there are chains that are currently coming out to try to address some of the challenges of requiring all your users to hold this other thing to pay fees in, right? Which is challenging. So there are some chains that are out there, like you've seen from Stripe and from other consortiums that are aiming to try to either make the fees cheaper or to allow for gas sponsorship so that the issuer themselves can sort of try to take that burden away from the end user, or in some cases, the chains just trying to remove these types of fees or make them fixed. And then lastly, some of them are also trying to make the fees payable in the stablecoin itself. So whatever chain and stablecoin is utilizing and being paid. Like, so if I was remitting USDC on ETH to somebody, that potentially that, or ETH is a bad example, but on one of these novel new blockchains, that the fee could be assessed in the stablecoin that I'm remitting, as opposed to requiring like another native token. So there's a lot happening to try to abstract away that difficulty with stablecoins.
Thank you very much.
All right, we've got 15 minutes left if we're going to end on time. Let's go, Professor Orenberg, you have a question?
Thanks. Yeah, I have two, but if, I'll ask one, see if there's maybe time for a separate one. So my understanding, just to get the terminology right, is that programmable payments are incredibly important for AI agents to use stable tokens, and a lot of the microtransactions are going to rely on that. But you mentioned that there's a gap, maybe a probabilistic versus deterministic gap, where big banks get a guarantee of what they can get in cash, but everyone else has to use these crypto exchanges where there are market mechanisms, but the market mechanisms can fail. And so instead of having a deterministic programmable payment, most agents that don't have direct access have a probabilistic programmable payment. So you can tell me if that's right or wrong so far. But if that's right, that creates an issue where you now have probabilistic agents, which that just doesn't function as well as a deterministic agent. So could a state like New Hampshire, basically is what I'm getting at, could a state like New Hampshire get to a deterministic, could they offer a product where we could have deterministic programmable payments on our stable token by having some type of direct access the way that banks do for these AI agents? And so is that even is that the technical solution? And if it is, what are some of the risks or systemic risks that might raise?
Yeah, that's a really good question. So I think when I was referring to kind of deterministic method of payment, I wasn't referring to the value of the asset that's being used to settle with. But I do agree with you that in that sense, it is somewhat probabilistic because you don't have a direct relationship with the issuer in that scenario. What I was referring to is if I use an ACH transfer to pay you, Professor, and you're a business, I can withdraw those funds, right? Meaning in the sense that I can go and reverse the funds by saying I don't recognize this transaction, and those funds would basically get reversed, and then there would be a dispute process between us. Same thing with credit cards and all these different things. And the reason that those exist is there's a consumer protection in place for fraud, for different types of liability, and then credit card networks also enforce these types of things as well, right? To create mechanisms where consumers can be reparated for things that may have done that they didn't instruct. So when you put an agent in front of those, it's difficult then for an agent who acts on behalf of Professor Orenberg. It's difficult then for any of those to be respected, because it's is that agent really a proxy of you? And therefore, should that agent be able to recall the payment, or should the payment have been able to happen altogether? In fact, I think Amazon recently sued an AI provider for testing this. Not because they necessarily disagree, but because they don't believe there's sufficient precedent for this type of behavior. So I was more referring to that, which is a stablecoin isn't, and any crypto transaction is effectively deterministic because there is no intermediary who can come and say, let's reverse that transaction because we believe fraud occurred. So that's sort of what I meant by agents need a mechanism where they can transact some type of stable value that can't be reversed, because that way the actions that it's doing perpetuate, as opposed to then creating these massive gaps of missing funds and things like this. Yeah.
Could I substitute immutable? You were using deterministic in the sense of immutable.
Exactly, where you can't recall or reverse those transactions.
Okay, not deterministic as in certain. Yeah, in a probabilistic sense. Okay,
Yeah. To your point though about New Hampshire taking a different view about access to the issuer and the ability to mint or burn. I think New Hampshire could certainly take a stance, but I actually think it likely heads that direction anyways. Because over time, especially as like banks themselves begin to, take stablecoins as deposits or remit stablecoins, or issue stablecoins of their own, like more and more the expectation will be that folks will have more and more direct access to be able to mint or burn or get access to stablecoins in general. So I think the current market that relies on purely this arbitrage mechanism, like I think it's going to continue to get wider and wider in terms of who has access to mint or burn. But I also think like requiring that from the AI perspective also has some challenges, which is of just like who's responsible, right, for these AI agents, and then how you would sort of qualify the validity of those things and who should have access to mint or burn. So, yeah.
I'm imagining like a contagion issue where if those AIs are all operating under a similar set of assumptions, they could also all make choices to mint or burn if they had that direct access.
Exactly.
In some kind of like cascading way, like
choose,
kind of like the flash crash in what was it, the 80s or what have you. You could have some type of flash crash event.
Yeah, you could have some, exactly, like coordinated events that the issuer now has to face relative to liquidity and stability assets. So, I don't have like a perfect answer. I think in general, like issuers are going to provide more and more access, as opposed to the very small group that they typically offer this to today. I think that's going to continue to put pressure. As an example to that, like at BitGo, in the near future, we are going to be enabling the ability to mint and burn USD1 to anybody who holds a BitGo account. And so that's just an example of us like also kind of believing in that notion that the wider the primary market is.
Can agents operate those accounts?
Currently at BitGo, agents cannot operate BitGo accounts. But in the future, if we do allow those things, folks will be able to set policies to control what they do, and they do not want agents to be able to do with their accounts.
It's a brave new world. So we got 10 minutes left. I have a question I want to get in, if you don't mind. And you mentioned the network effect, and that is like the gorilla in the room. And the network effect, the network gets more useful, the more people that use it. If you start up let's say you want to start Facebook tomorrow and you're the only one using it. The problem is attracting attention away from the larger network to the smaller. The $10 billion threshold, that guarantees that all these state chartered stable coins are going to be tiny networks if they can even get off the ground. So how do you see bridging occurring between state chartered stable tokens? How is that going to play out in the real world? Why would anyone use it? What are the use cases? And if the liquidity is siloed into tiny little silos, that's going to have it's going to suppress any, it's already hard enough to beat the network effect out in the wild. Now you have some regulatory pressure to prevent that. How do you see that playing out in the real world?
Yeah, there's probably like two different ways that I would see this playing out. One is like less interesting than the other, but one way this plays out is like the world really centralizes around a few winners, right? And these assets just continue to grow, and they continue to need to provide, like, to become less and less of the way they are now and more of like consortium type behavior, because the broader they get, the more constituents that they serve, the more rules and things we put in place to help them. So that's like one potential path, probably less interesting, but that's a possibility. And then you run into a lot of these issues of like, now those assets pose like more risk because there's like just centralized liquidity, right? As they grow larger and larger and larger. The second path, which I kind of choose to think is the more likely, is one where we just live in a world where there's like, 1,000+ stablecoins in the world and in the US. And there's just a lot, there's almost like a play where a lot of different financial institutions and banks basically choose to issue their own stablecoins. And there will be mechanisms either from like a clearinghouse type of perspective. We use that model where there will be the ability to clear like some central way that has direct relationships with issuers across the board, where a clearing mechanism can kind of take place. So similar to like checks, right? When banks are writing checks to one another, that there's like a clearinghouse like network where everybody's playing by the same rules. That's like one potential outcome. And there's a number of infrastructure providers who believe in that model and are working towards that right now. The other is that maybe this takes form in a much more simplistic fashion, where this looks a lot more like Swift in the very beginning, where let's say there are a bunch of these banks that issue their own assets, and there are basically some banks that will then integrate directly with these providers, and it looks more like a correspondent banking relationship, right? Where if Bank of Jim wants to accept stablecoin deposits of USDC, he might have a correspondent bank account at another bank, and they actually receive the USDC and credit that account, right? And then now Bank of Jim essentially has received the deposit. So I think that's like another potential outcome here, but somehow there will be a clearing and settlement mechanism between all these assets, is my belief.
Well, if I'm a consumer, I want as little friction as possible, right? And so why wouldn't that mean a decentralized protocol that I use to bridge between the two? I think in the world that we live in, the least friction way is to use a decentralized protocol to bridge, right? Don't you see that as being how liquidity will move between stable tokens?
It might seem that way, but I think I would like to believe that is true as well. I think people like to have an intermediary with their money. And maybe this will change when we're all gone, but I think in the near future, I think people do want to have a place to call. They want to have a place to interact with that they believe is like helping ensure that the right things happen to their money. And so I generally think, like, even today, there's lots of protocols that will help you bridge assets from one chain to another, from one stablecoin to another. There's a lot of these different solutions. They're largely just used by trading desks. There's not much like the direct end consumer. Even today, with the current use cases around most crypto use cases are around trading and speculation for stablecoins. Or local currency hedge. Those protocols are largely just used for the trading side of it. So I think like it's difficult for me to see a path where like the average American wants to sign off from their insured bank account per se, and then interact solely without an intermediary to help. Yeah.
We're just talking about AI agents, right? So
I'm sorry.
A lot too.
Yeah.
But I'm saying, Anyway,
I'm sorry, I must have missed
a whole bunch of thoughts into it. Fine. So I have a bunch of other questions. I'm going to hold off. Maybe I can talk to you offline.
I have one.
Okay, you have one? Yep.
You want me to go now?
Yeah, go ahead.
This kind
We're
of
gonna run long.
little slightly off topic. So New Hampshire, we have no income tax, no sales tax, no property tax. Are you seeing with stablecoin versus tokenized deposits, stuff like that? Are you seeing states tax things differently? I don't know if there's still clarity how stablecoins done by the IRS. Maybe it is. I missed it. But do you see anything that New Hampshire could possibly do that way to give us an advantage?
That's a good question. I think stablecoins essentially right now fall under like the same tax rules of cost basis, but just given that there's really not much variation there, then effectively you're not paying tax. I guess on like the tiny spreads that we talked about. It could be worthwhile. It could be worthwhile for New Hampshire to take a stronger stance on that you see that as cash, for example, and therefore these transactions aren't subject to that. Or you have some unique opinion for state taxes around how you see those. At present, I don't know that makes a huge difference, just given, again, that it's a very minor consideration in the broad scheme of things. I'm trying to think off the cuff. There's probably a couple of things I could think of on the tax side that you could do, but I'd probably need to put more thought into it.
So we'll wrap up here unless anyone has an urgent question they want to get out. I just want to inject one other thing. To the extent that you can speak about it, BitGo, I think, is the custodian for our business finance authorities conduit bond issuance. Do you want to mention any relationship you already have with New Hampshire, and to the extent that you can?
Yes, I probably within BitGo have the least exposure to that right now, but yes, we do interact. And maybe I think Mike Gross might be on. He might be able to speak a little bit more clearly to that from the BitGo side, but I don't want to misspeak.
Yes. Hi, sorry. Nice to meet you all. Yes, BitGo is the custodian for New Hampshire's Bitcoin backed municipal bond. So we've been working with the state for a little bit of time now. So that's basically it.
All right, I think that's interesting to know for the commission. All right, thank you very much. Sorry it was rushed at the end. But wealth of information, it's going to definitely help inform our final recommendations. So thank you very much for that. I'm just going to rush through the rest of this, but not the public comment portion. So take as much time as you need. Members of the public, do you want to just go around the room and just very quickly say your name and who you represent? And I'll just start on my left. You want to?
Yes, Sean Thomas. I'm a lobbyist with Demers Praisall and Thomas. We represent Bank of America and just here sort of tracking the commission's work. Thank you.
Isaac Folmsby, I'm from Derry, New Hampshire. I don't represent like any specific like organization, but just interested in the policies being made, how that would affect developers and such.
Cool. Would you like to finish?
Yeah, Karen Parker-Feld. I'm also an independent participant in the commission, although I did spend 40 years in finance. And I was hoping at some point, maybe the next meeting or whenever you feel that there's an opening in the schedule to kind of complement this market microscope conversation with kind of a big picture macro analysis of what this next step in securitization, tokenization might mean for asset markets and economic policy, and how sort of I would think about the consumer protection question from a macro standpoint.
You want to develop that into a formal presentation?
I would like to. I've actually written up kind of the outline already, but I can break it into, I can hand that out as a written document, but I can also bullet point it into a presentation.
That would be excellent. Anybody online would like to just introduce themselves for record? I see Woody online.
Right, thanks, Keith. Just a member of the public, mostly interested in this for education purposes because I develop courses at AIL and Osher.
Excellent. Thank you, Woody. Anyone else online that I'm not seeing? And then, so I don't see anybody else online. Any brief statements from the public, or if you'd like to go on as long as you want, that's definitely, I'm sorry, the time constraint, but I have to be at another meeting soon. You want to?
I'll wait until my turn comes
Yeah,
up.
we'll give you a whole hour.
Oh, wow,
45
okay.
minutes or whatever you want.
Try not to waste anybody's time.
All right. Okay, then just to finish up our agenda here, commission member reflections. I've been getting a lot of feedback from many of you, so I really appreciate that. I've been trying to incorporate that into our larger discussions, so please continue to do that. Alternative viewpoints. Amelia sent me something that she thought might, and this might help you in your presentation. Let me see if I can find it quickly. I'm just going to point it out and you can, in your free time. Let's see. This Federal Reserve working paper is from the Boston Federal Reserve. And it goes through a lot of the things that you're concerned about. So Amelia sent that to me. That's an analysis. The original document is here at this link. So that's definitely something we should consider as far as talks about risk, contagion, and all that, those types of questions from the banking industry. Identifying areas for the research, please send me all your suggestions for that. We did cover algorithmic stable coins, so thank you to BitGo for including that into their presentation. That was one that was open item. And then we just have to set the next date. And I think we already have we have 2 presenters lined up. I'm planning a pace of just 1 a month, but if we need to do 2 a month.
Is that including her?
Well, so you would go in May.
Okay.
If you confirm that with me and I'll put you on schedule. So April, we have SoFi lined up, which BitGo just mentioned they're the provider for.
Yeah, that's interesting.
And we have Chainlink lined up, which is sort of like it's a blockchain that connects a lot of other blockchains. So talking about bridging and that kind of thing. So Chainlink and SoFi. And let's set the meeting date currently.
Do you want Mondays, Fridays, you said?
Yeah, Mondays and Fridays because we have legislative business. And I know personally, Jim, do you have a preference on day of the week?
Mondays and Fridays usually.
Yeah.
Tuesdays are okay for me as well,
Tuesdays.
but not I get Mondays and Fridays are best. For us, April 6th or 7th would be good if you want to do Monday, Tuesday, or not until the end of the week, right end of the month, which is that school vacation week, the 27th, 28th.
I could try to, I may have to miss something at the State House if I do the 7th, but I could probably get a substitute.
Or the 6th we can do, so. If you guys want to do it Monday.
What's the consensus? Online, feel free to shout out.
I could do the 6th, but not in the afternoon.
So what, 10 a.m. on 6th?
Works here.
I can do the 6th.
Yeah.
6th work, 6th of April, yes? We're talking?
Yes, yeah,
Yes. Looks good.
all right. Any objections to that date?
Nope, this is works for me.
I don't have any availability Mondays or Friday afternoons, especially on the 6th. I'm totally booked from 1 until the end of the day on the 6th, but Monday and Friday afternoons, generally, I have standing meetings. The mornings are okay.
But the 6th, you don't have morning open.
Morning I do, but not the afternoon.
Okay, so we're good at 10.
Okay, so 10 a.m. on the 6th is good. Okay.
Night, was it possible to book in May? Going too far ahead?
It's probably going too far ahead, but figure about the same.
Mondays,
Second one.
Mondays would be great.
Okay.
Yeah.
We're free on all the first 3 Mondays of the year.
You want to set the date now, just the
It's up to you. There's the
What's the
4th,
first one?
11th.
first one?
4th is the first one, Star Wars Day. but
Let's tentatively set that April 4th for 10 a.m.
Okay.
You mean May 4th?
May
April
4th, sorry.
6th, May 4th?
May 4th. Yep.
May the 4th be with you.
Yep.
Star Wars Day.
May the 4th.
All right, and so any other final thoughts? I'm gonna just wrap it up here.
I just wanted to highlight that the consumer protection dimension with maybe some requirement to name stablecoins by function was something we could explore a little bit later, because these things really are quite different, even though they have the same name. And that was touched on, but I think that's worth looking at further.
All right, and I know you have a Scrivener's error in our statutes that you want to tell me about more. I'll get with you offline.
Okay.
Not in the bank, I don't think. And Seth, could you send me what info you have on that and
Yeah,
we'll
it's just
figure out how-
it's very simple. I just mentioned it here. Like one of the statutes says limited liability company, where it should say limited partnership. And I'll send you the exact line item. And I checked the RSAs, and it was almost certainly a Scrivener's error from a copy paste. And I'll send it to you over email.
Get that fixed. All right, thank you, everyone. It is 12:07, and we'll close the meeting. Thank you.
The FITCO presentation was really, really good. Thank you.
Yeah, that's all.
Thanks.
I could probably go back there, but if you don't mind, here it's a lot.
Yeah, it's fine. Yeah.
You guys prefer it over here? I know it might.
This was great. Thank you so much for always thinking.
Yeah.